Aggressive Federal Reserve interest rate hikes, the economic stress from the conflict in Ukraine, and persistently elevated inflation have investors concerned about a potential U.S. recession coming at some point in the next year or two. When the U.S. economy tanks, even most high-quality stocks get dragged down with it. However, during the past two U.S. recessions in 2008 and 2020, there were still a handful of stocks that significantly outperformed the S&P 500. These recession-resistant stocks can help you play defense if a bear market does occur. Here are 10 recession-proof stocks to become a billionaire. 10. Chevron, CVX. Chevron is one of the world's largest integrated oil giants and also a dividend aristocrat. The company's long-term focused and disciplined management culture has proven to be the second best in the industry, behind Exxon, at lean operations and generating strong returns on invested capital over time. During the oil crash from 2014 to 2016, for example, Chevron slashed its drilling expenses by 50%, and management believes it can get that figure to 80% by 2020. Simply put, the company is laser-focused on capital allocation, with 75% of its $18 billion to $20 billion annual capex budget going to projects that can begin generating cash flow within 2 years or less. As a result, despite relatively modest capex budgets, management expects production to grow by 4% to 7% per year and fuel a 30% increase in free cash flow by 2020, even assuming oil prices average just $60 per barrel. Chevron's stock performance during the financial crisis was surprisingly solid. Specifically, Chevron lost 34%, while the S&P 500 dropped 55%. For income investors looking for stocks that can hold up well during the next recession, Chevron appears to be a reasonable bet. 9. ExxonMobil, XOM. Normally, one wouldn't think that companies in cyclical industries tied to volatile commodity prices would make for good stocks to own before a recession. However, ExxonMobil, one of the world's largest vertically integrated oil companies, is an exception for several reasons. More important than diversification is the company's track record of conservative and disciplined capital allocation. Exxon has historically been the most profitable major oil giant thanks to management's superior ability to identify and invest in projects that generate some of the industry's best returns on invested capital. That's partially due to the firm's relatively good record of avoiding project delays and cost overruns, as well as enjoying the lowest rate of asset write-downs of any of its major peers. 8. Consolidated Edison, ED. Consolidated Edison was founded in 1884 and is a regulated electric and gas utility serving the New York metro area. Over 90% of the company's earnings are derived from regulated activities, providing a predictable and fairly recession-proof earnings stream. As a result, Con Edison has increased its dividend for 44 consecutive years, the longest streak of any utility in the S&P 500 index. Perhaps more impressively, the firm's dividend payments can be traced back to 1885. To make sure consumers continue to have dependable utility services at reasonable prices, Con Edison's utility operations are regulated by the New York Public Service Commission, which determines the projects the company can invest in and how much profit it can make. Due to the capital intensity of transmission infrastructure and the government's desire to keep electricity prices fair for consumers, regulated utilities usually earn a relatively low but stable return on equity. 7. PepsiCo, PEP. PepsiCo is one of the oldest, founded in year 1898, and largest drink and snack makers in the world, selling dozens of brands in over 200 countries and territories. The company owns 22 iconic brands, such as Pepsi, Gatorade, Tropicana, Lay's, and Quaker, which each generate over $1 billion in sales. Like Coca-Cola, PepsiCo's products are recession-resistant since people need to continue eating and drinking no matter how the economy is performing. In fact, the company's sales dipped just 0.5% during the Great Recession, and its free cash flow per share actually increased. PepsiCo's wide moat is courtesy of its strong brands, built up over more than 100 years of steady advertising. The firm owns the top 7 salty snack brands and claims that 90% of its retail sales are from brands with number 1 or number 2 subcategory share position. With a 45-year dividend growth track record and uninterrupted dividend payments dating back to 1965, income investors can sleep well knowing that PepsiCo's payout should remain safe in virtually all manner of economic environments. 6. Kimberly-Clark, KMB. Like Procter & Gamble, Kimberly-Clark is a time-tested, Founded in 1872, consumer staples behemoth, selling name-brand products as Cottonelle toilet paper, Scott paper towels, and Huggies diapers in over 175 countries around the world. Emerging markets account for around 30% of sales. Demand for these products is recession-resistant, which is why Kimberly-Clark's earnings and free cash flow per share actually increased during the Great Recession, and its sales only dipped 4.3%. The mature nature of the tissue and hygiene market adds to the difficulties new entrants face. Product use cases in these markets don't change much over time. For example, diapers will continue doing the same job with only incremental technology improvements, such as better sealing. Another competitive advantage Kimberly has is its FORCE, focused on reducing costs everywhere, cost savings plan, which has reduced operating costs by $3.3 billion over the past 13 years. 5. Leggett & Platt, LEG. Leggett & Platt is another name in a cyclical industry that has proven that conservatively run industrial companies can still be dependable high-yield dividend growth investments. Leggett & Platt is over 135 years old and has built itself into a leading global provider of components used in bedding, furniture, carpet, automobiles, aircrafts, and other products. Some of its offerings include inner springs, recliner mechanisms, adjustable beds, steel wire, seat frames, carpet cushions, and armrests. The manufacturer's competitive advantages and what makes it a good recession stock to consider include the slow-changing nature of its markets. As a result, most of Leggett & Platt's products have long life cycles and low R&D intensity since they do not have to be continuously redesigned. In fact, Leggett & Platt usually spends less than 1% of its revenue on R&D, but thanks to its long operating history, the firm has built up over 1,300 patents that give it strong pricing power with customers. This little-known industrial stock can be an attractive holding even during recessions. 4. Altria, MO. America's largest tobacco company commands dominant market share as a result of its portfolio of leading cigarette brands, including Marlboro, Parliament, Virginia Slims, and Benson & Hedges brands. Marlboro alone commands about 40% of the U.S. cigarette market. Fundamentally, what makes Altria a potentially great recession-proof stock is that its customers are extremely brand loyal and continue to buy its products no matter the state of the economy. Sales grew in 2008 and 2009. This gives the business very strong pricing power. Historically, the company has raised its cigarette prices 4% to 5% annually, which is how Altria is able to slowly grow revenue despite steady volume declines in U.S. cigarettes. During the financial crisis, the company's stock only declined 20%, while the S&P 500 plunged 55%. This cash cow should remain a durable and financially healthy business for the foreseeable future. 3. Coca-Cola, KO. Coke's wide moat is courtesy of the world's largest distribution network, which has taken over 130 years to build up at a cost of tens of billions of dollars in marketing spending. Smaller rivals simply can't replicate the company's reach or brand awareness. As a result, Coke enjoys premium shelf space in almost every retail outlet in the world. Recently, this focus on healthier beverages has helped drive mid-single-digit organic sales growth, which is among the best in the industry. While the firm does need to invest somewhat aggressively in beverage categories of the future, Coca-Cola should have flexibility to keep its dividend moving higher along the way. 2. Johnson & Johnson, J&J. Johnson & Johnson has managed to raise its dividend each year for more than half a century, demonstrating its ability to endure many different economic environments. A key to the company's success is management's focus on only competing in markets that J&J can dominate. In fact, about 75% of the firm's revenue is from number 1 or number 2 global market share positions. Over 20% of sales are also from new products launched within the past 5 years, highlighting the company's ability to continuously innovate and adapt. During recessions, consumers still need to have their medical issues treated. As a result, Johnson & Johnson's sales only declined by 6.2% during the financial crisis. Number 1. Procter & Gamble, PG. In recent years, Procter & Gamble has undergone a major restructuring, selling over 100 of its smallest and least profitable brands, about 15% of total revenue, to refocus its investments on its strongest and most profitable ones. As a result, the business was able to reduce costs by $7 billion. Going forward, management expects to cut an additional $10 billion over the next 5 years by improving the firm's factory automation, streamlining its supply chain, and refocusing its advertising budget. If successful, these initiatives should boost P&G's already impressive free cash flow margin, which at 15% is among the highest in the industry. Which one of them would you like to have? Thanks for watching.